In May 2013, a team of federal prosecutors sent a single legal document to a web hosting company in Costa Rica. Within hours, a digital financial network that had processed more than $6 billion in transactions across more than 1 million users in dozens of countries, gone. One document. Done. The network was called Liberty Reserve, and the day that document was sent, the website went dark. Access to funds was immediately cut off for over 1 million users worldwide, with no warning, no transition period, and no functioning recovery mechanism available at that time. And the reason that was possible comes down to one architectural fact. Liberty Reserve was centralized. It had a registered address in Costa Rica, identifiable operators, and a single cluster of servers that a legal document could reach. Now here is what governments understood the second decentralized finance started gaining real traction at scale. What worked on Liberty Reserve does not work on a protocol with no registered company, no CEO, no identifiable server cluster, and no single operator whose prosecution shuts down the network. Around 2020, or the start of 2021, the first time I came across the claim that a financial system could exist where no bank, no government, and no company could freeze, seize, or reverse a transaction without the owner's consent. I wanted to understand if that claim was actually true. So I went deep into the cryptography, the peer-to-peer mechanics, the smart contract architecture, the tokenization frameworks, the decentralization principles. The further I went, the clearer the institutional implications became. This video is the complete breakdown. That single architectural difference, centralized versus decentralized, is the specific reason for everything this video covers. Before we go any further, this video is not a recommendation to buy, invest in, or use any DeFi protocol or cryptocurrency. And it is not anti-government. It is an honest structural analysis of why this tension genuinely exists, what it is specifically based on, and what the published evidence says about where it goes. Here is what this video is going to give you. And I want to be specific about this, because this is exactly what mainstream financial media coverage of this topic almost never provides. First, the three specific levers governments hold over money that decentralized finance creates architectural pressure on simultaneously, explained mechanically, not politically. Second, the documented historical pattern of what governments have actually done every time a monetary alternative reached meaningful scale, going back 90 years. Third, and this is the part that most people who form opinions on this topic have never actually done. What published design documents from the Bank for International Settlements, the European Central Bank, and the People's Bank of China specifically say about programmable digital currency design? Because almost nobody in mainstream coverage reads those documents, and they are publicly available. By the end of this video, those three things are going to be clear, not speculated about, not framed ideologically. Clear, based on verifiable sources. Stay with me. To understand why governments fear decentralized finance, you first need to understand what governments actually have at stake, mechanically, not in a vague general sense. Because the concern is not simply about control for its own sake. There are three specific, documented mechanisms through which modern governments exercise authority over monetary systems. These are not political constructs. They are operational realities that shape how central banks respond to economic crises, how international sanctions are enforced, and how governments manage currency stability. Decentralized finance creates documented architectural pressure on all three of these mechanisms simultaneously. That combination, simultaneous pressure on all three, is what makes DeFi categorically different from any previous financial technology or monetary alternative. Lever 1. Monetary policy transmission. When a central bank lowers interest rates, which is its primary tool for stimulating an economy in recession, the mechanism by which that rate change reaches the broader economy is the commercial banking system. Lower rates reduce the cost at which commercial banks can borrow from the central bank. In theory, commercial banks pass this through as cheaper credit to businesses and individuals, which stimulates borrowing and investment and economic activity. One primary mechanism for this transmission, the bank lending channel, depends on economic activity being routed through the regulated banking system, where the central bank's right decisions have the most direct application. Which is, as institutional concerns go, a fairly precise way of acknowledging that central banks are not entirely certain their primary economic tool continues to function the way it was designed to function. The IMF published a working paper on exactly this question, examining the implications of central bank digital currencies for monetary policy transmission, and specifically what happens when bank disintermediation occurs and a meaningful share of lending and borrowing activity migrates outside the banking system. The concern they documented: if significant economic activity occurs outside channels where central bank rates have direct influence, the connection between monetary policy decisions and real economic behavior weakens. This is not a fringe concern. This is in the published research of the International Monetary Fund. Lever 2. Financial surveillance architecture. The current global financial system is built on a surveillance architecture that has been constructed deliberately over decades. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is the messaging network through which the vast majority of international bank-to-bank payment instructions are processed globally. If you want to understand how SWIFT functions as a tool of financial surveillance and enforcement, I made a full video on the structural mechanics of that system and how it connects to dollar dominance and geopolitical leverage. It is in the info cards and directly extends what we are covering here. The vast majority of high-value international bank-to-bank payments in the current system pass through at least one node in this architecture, a node that can be instructed by a government with sufficient jurisdiction to block, freeze, or report a transaction. Sanctions enforcement works through this architecture. When financial sanctions are imposed, the enforcement mechanism is that sanctioned entities cannot access SWIFT, cannot use correspondent banks that process the relevant currencies, and cannot participate in the dollar clearing system. Tax compliance monitoring works through this architecture. Bank reports, know your customer requirements, suspicious activity reporting. All of it flows through regulated financial institutions that are legally obligated to participate in the reporting system. Anti-money laundering enforcement works through this architecture. DeFi, at a structural level, is a system that allows two parties to transact directly with each other, with settlement finality, without passing through any node in this surveillance architecture. That is not a political statement. That is a technical description of how direct peer-to-peer blockchain transactions work. Lever 3. Capital controls. When a country faces a severe currency crisis, when its domestic currency is losing value rapidly, when capital is moving out of the country faster than the government can respond, the emergency policy tool is capital controls. These are restrictions on how much money citizens and institutions can move across borders, in what currency, and through what channels. Argentina has implemented capital controls multiple times in response to currency crises. Iceland implemented emergency capital controls following its 2008 banking crisis. Cyprus implemented them in 2013 during its banking crisis. Greece implemented strict capital controls in 2015 during its debt crisis. These are verified historical cases. Capital controls are a real operational tool, not a theoretical government power. Capital controls work in the current system because moving significant sums of value across borders requires the participation of regulated financial intermediaries, banks, wire transfer services, payment processors that can be legally instructed to halt or limit transfers. A stablecoin transfer bypasses the correspondent banking infrastructure. It requires no SWIFT message, no correspondent bank relationship, and can be executed without either party holding a traditional bank account. However, the accurate picture has a critical nuance that most coverage omits. Most major stablecoins, including USDT issued by Tether and USDC issued by Circle, are issued by centralized companies whose smart contracts contain a blacklist function, allowing them to freeze specific wallet addresses when required by law. Tether has frozen over 7,000 wallets and more than $3 billion in assets in documented law enforcement cooperation. Circle has done the same. The transfer mechanism bypasses traditional banking rails, but the stablecoin issuer itself retains centralized control over the asset. This is a form of centralized pressure point that governments have already engaged directly and successfully. Now, and I want to be precise about this before we go further, these three levers are not instruments of oppression by design. Monetary policy transmission is the mechanism through which recessions are responded to and economic activity is supported during crises. Financial surveillance is the mechanism through which terrorism financing is disrupted, drug trafficking proceeds are traced, and financial fraud is investigated. Capital controls are the mechanism through which countries have historically prevented complete currency collapse in acute crisis situations. These are real functions with real documented justifications. The honest analytical observation is simply this: decentralized finance creates architectural pressure on all three simultaneously, not by design, not as an ideological mission, but as a consequence of the architectural properties that define what decentralized protocols are. That is why the institutional response to DeFi is what it is. And that is why governments are not just trying to restrict DeFi, they are simultaneously building their own version of programmable digital money. But before we get to what those design documents actually contain, which is Chapter 4, and it is worth getting to, you need the historical context for this confrontation. Because what is happening with DeFi today is not the first time a monetary alternative has created significant pressure on governmental monetary control. And the historical pattern of what governments do in response is remarkably consistent. The reason this analytical framework for understanding monetary systems matters, not just for this video, but for understanding every major financial development, from central bank policy to geopolitical capital flows, is that most people never receive a structured education in how these systems actually work at a foundational level. I built a complete course around exactly this. It is titled Applied Macroeconomics, the Architecture of the Global Monetary System. Total course video content, 2 hours plus, intentionally stripped of filler, built entirely for clarity and real understanding. Module 10 covers exactly what this video is about, the future of monetary architecture, including central bank digital currencies, decentralized finance, and the structural tension between them. Email support is included to get your questions clarified directly. The link is in the description. If you want to understand the full architecture behind what we are covering in this video, that is where to go. Now, back to what history shows us, because this is where the context for the entire modern confrontation begins. And if you think the historical pattern is significant, wait until Chapter 4, where we go through what actual published documents from the world's most powerful financial institutions say about programmable money design. Most people who have strong opinions about this topic have never read those documents. The content of them is genuinely worth understanding clearly, and we cover it in full. The historical pattern is this: virtually every documented monetary alternative that achieved sufficient scale in the 20th and early 21st centuries, scale meaning measurable pressure on at least one of the three governmental levers, eventually faced a documented institutional response. The pattern is consistent across different governments with different political structures, different decades, and entirely different monetary technologies. And in each case, the trigger was not simply the existence of the alternative, it was the scale. Small-scale monetary alternatives that do not create measurable institutional pressure tend to be tolerated or ignored. The moment a monetary alternative reaches a scale where it begins to affect the operational levers of monetary policy, financial surveillance, or capital flow management, the response comes. Let us go through the cases. Case 1, April 5th, 1933, the United States of America. President Franklin Delano Roosevelt, the 32nd President of the United States, who at this point had been in office for approximately 1 month, signed Executive Order 6102. The order made it illegal for most U.S. citizens to hold gold coins, gold bullion, or gold certificates above a small nominal threshold, and required them to deliver their gold holdings to Federal Reserve banks at a government-set price of $20.67 per troy ounce. Before the specifics of this case are used as a simple narrative, it requires precise historical context. The U.S. was on the gold standard at this time. Under the gold standard, the government's ability to issue currency was directly constrained by the gold holdings it could maintain against that currency. The United States was in the depths of the Great Depression, the most severe economic contraction in American history to that point. Roosevelt's administration was attempting to implement the New Deal, a large-scale government spending program, as a response. Private gold ownership at scale constrained the government's monetary policy lever directly. Citizens holding gold rather than Federal Reserve notes effectively withdrew those funds from the monetary circulation the government was trying to expand. So the order was issued. It applied specifically to persons within U.S. jurisdiction and had documented exemptions for gold used in industry, jewelry, and small personal holdings. But the structural consequence was unambiguous. The primary private monetary alternative to government-issued currency, physical gold held in meaningful quantities, was prohibited by executive order. U.S. citizens were not legally permitted to own meaningful quantities of gold for more than 40 years after this order. 40 years. The order was not lifted until December 31st, 1974, when President Gerald Ford signed legislation restoring the right of U.S. citizens to hold gold. Case 2. E-gold. In 1996, a Florida-based oncologist named Douglas Jackson founded a company called e-gold Ltd. The concept was straightforward. Customers opened accounts denominated in grams of gold, backed by actual gold held in vaults. Account holders could transfer grams of gold to other account holders instantly and with settlement finality. The system grew significantly through the early 2000s. According to figures widely cited at the time of the prosecution, e-gold was processing in a range of approximately $2 billion in annual transaction value by the mid-2000s, making it, at that point, one of the larger independently operating electronic payment systems in existence. In December 2005, U.S. federal law enforcement executed search warrants on e-gold's offices. In April 2007, the U.S. Department of Justice indicted e-gold and its principals on 4 counts, including conspiracy to engage in money laundering, operation of an unlicensed money transmitting business, and conspiracy to operate an unlicensed money transmitting business. The prosecution's evidence included the system being used for documented criminal activity, including transactions linked to fraud and identity theft operations. The business was effectively shut down as a usable service in the years following the indictment. In July 2008, the founder pleaded guilty to conspiracy to engage in money laundering and operating an unlicensed money transmitting business. The structural observation from this case, a digital currency system with meaningful transaction volume, operating outside the regulated banking architecture with centralized operators, was subject to exactly the same legal tools used against any other centralized financial business. The application point was the operator. Case 3. Liberty Reserve, May 2013. This is the case that most directly illuminates the architectural argument at the center of the DeFi confrontation. Liberty Reserve was a digital currency service incorporated in Costa Rica in 2006. By the time of its shutdown, it had processed approximately $6 billion in transactions and had accumulated over 1 million registered users, with more than 600,000 accounts associated with users in the United States alone, according to the U.S. Department of Justice. The system allowed users to register with minimal verified identity information, convert conventional currency into Liberty Reserve dollars or euros, and transfer those units to other users with mere instant settlement and low fees. On May 24, 2013, in what prosecutors at the time described as the largest international money laundering prosecution ever brought, the U.S. Department of Justice, coordinating with law enforcement across 17 countries, executed the shutdown. The founder, Arthur Budovsky, was arrested in Spain the same day. The website went dark within hours. One coordinated legal action. Over 1 million users. Gone. The honest assessment of this case requires stating clearly what Liberty Reserve was. The prosecution's evidence documented extensive criminal activity running through the platform. Money laundering connected to credit card fraud, identity theft, and financial crimes at scale. This was not a legitimate alternative currency being suppressed for ideological reasons. The legal case against its operators was substantive. The structural observation is the architectural one. Liberty Reserve was a centralized service. It had identifiable operators. It had a single point of legal pressure. The legal pressure was applied. The network ceased to exist. Nobody talks about this part. The fundamental architectural motivation behind the design choices in decentralized systems. No single operator, no central server, no identifiable point of legal pressure, is not incidental to the history of digital monetary alternatives. It is a direct architectural response to that history. The people building these systems in the years after Liberty Reserve understood exactly what happened to every centralized alternative. The architecture of decentralization was not designed as an ideology. It was designed, at a functional level, as an answer to the question, what happens if there is no single operator to prosecute? Case 4. China, September 2021. On September 24, 2021, China's central bank, the People's Bank of China, jointly published a notice with 9 other government authorities declaring all cryptocurrency transactions illegal within mainland China. This was a comprehensive prohibition covering trading, exchange, and facilitation of cryptocurrency transactions. Mining operations, which had made China the largest Bitcoin mining country in the world before this period, were simultaneously ordered to shut down. Within weeks, the majority of publicly identifiable cryptocurrency mining infrastructure that had been operating in China relocated or ceased operations. The ban was effective within China's domestic regulated infrastructure. It was not fully effective in eliminating Chinese citizen access to cryptocurrency through non-regulated channels. A significant portion continued to access international platforms through technical workarounds. That distinction between restricting regulated access points and restricting actual underlying use is one of the most analytically significant and least discussed nuances in the entire record of governmental cryptocurrency responses, and it connects directly to the DeFi architectural argument that follows. Now here is the context that makes this the most analytically significant case in the modern period. China was simultaneously in the active development and pilot deployment phase of its own central bank digital currency, the digital yuan, known internally as the e-CNY. The e-CNY pilot had been running in selected cities since 2020. By the time of the September 2021 comprehensive crypto ban, tens of millions of users in pilot cities had been issued digital yuan wallets. The sequence is documented and direct. The government moved comprehensively against decentralized monetary alternatives. At the same moment, it was scaling its own centralized digital monetary alternative. This is not a coincidence that requires explanation. It is a documented policy logic. The pattern across all 4 cases. Gold, 1933. E-Gold, 2007. Liberty Reserve, 2013. China Crypto Ban 2021. 4 cases, different countries, different decades, different monetary technologies, different political systems. The common thread is not a particular government's philosophy or political agenda. The common thread is this. In each case, the government acted when the monetary alternative had achieved sufficient scale to create measurable pressure on institutional monetary control. And in each case, the alternative had a centralized component, a physical location, an operator, a server, a company structure, that created a single point where legal or administrative pressure could be applied effectively. In each of these 4 cases, the intervention was effective. And here is the thing that makes the DeFi confrontation structurally different from every case in this history. The architectural response to find the single point of pressure and apply force is a system specifically built to have no single point of pressure. That is what sufficiently decentralized blockchain protocols are at a technical level, which is why understanding the mechanics of how DeFi actually works, not be ideology, be actual architecture, is the prerequisite for understanding the institutional response to it. The reason most mainstream coverage of DeFi misses the actual structural argument is that it approaches the topic almost exclusively through the lens of token price speculation and scam risk. Both of those things are real. Speculation exists. Scam risk in DeFi is documented and significant. We will come back to that, honestly. But neither of them is the structural argument that governments are responding to. The structural argument is about specific architectural features of decentralized systems. Let us go through the mechanics clearly and precisely. Section 1. Smart Contracts. A smart contract is a program that runs on a blockchain network and executes automatically when predefined conditions are met, with no central party initiating or approving the execution at the time it runs. The most useful real-world analogy to make this concrete? A vending machine. When you insert the correct amount of money into a vending machine and select a product, the machine dispenses that product automatically. There is no cashier whose approval is required. There is no manager who can intercede and decide not to dispense the product after the payment has been received. The execution is mechanical, determined entirely by whether the predetermined conditions were met. Smart contracts operate on identical logic for financial agreements: lending, borrowing, trading, structured products, insurance, running on a blockchain network rather than a physical machine. But here is what changes when this logic is applied to financial infrastructure at scale. The critical feature for governments attempting to apply the regulatory tools that worked against e-gold and Liberty Reserve. When a smart contract is deployed on a sufficiently decentralized blockchain, there is no single entity whose action or whose arrest can stop it from executing. There is no company to send a court order to. There is no server to seize. There is no operator whose prosecution shuts down the protocol. The code continues to execute on the distributed network of nodes running the blockchain, independent of what legal action is taken against any specific individual who may have written, deployed, or used it. This is not a hypothetical. The Ethereum blockchain has continued to process transactions without interruption since its launch in 2015, through multiple regulatory actions against specific companies and individuals in the Ethereum ecosystem. Section 2. Decentralized exchanges. A traditional exchange, whether a stock exchange, a currency exchange, or a centralized cryptocurrency exchange, is an intermediary. It takes custody of assets on behalf of its users, matches buyers with sellers, and can be required by the regulators of whatever jurisdiction it operates in to implement identity verification requirements, freeze specific accounts, and report suspicious transactions to financial intelligence authorities. The entire regulatory architecture that governments have built over the past several decades, know your customer requirements, suspicious activity reporting, sanction screening, assumes the existence of this type of centralized intermediary as the application point for compliance mandates. A decentralized exchange operates through smart contracts directly on a blockchain. Users trade directly from wallets that they control. The exchange itself takes no custody of assets at any point in the transaction. There is no account to freeze. There is no centralized database of user identities and transaction histories that can be subpoenaed. There is no operator whose cessation of operations stops the protocol from functioning, because the protocol runs on the blockchain regardless of whether any specific operator is active. The identity verification mandates that governments apply to centralized exchanges have no equivalent application point on a protocol that runs autonomously. This does not mean decentralized exchanges are without risk, and I want to be precise and honest about the documented risks. Smart contract exploits, where errors in a protocol's code are identified by adversarial actors and used to drain liquidity from the protocol, have resulted in verified significant financial losses across the DeFi ecosystem, with particular failures resulting in losses running into hundreds of millions of dollars in individual documented cases. In some cases, hackers have voluntarily returned funds, as occurred with the Poly network exploit of approximately $600 million in 2021, where nearly all funds were returned. In most cases, losses were permanent. There is no standardized institutional recovery mechanism, no deposit insurance equivalent, and no authority with power to mandate restitution. The absence of a central authority means no standardized consumer protection mechanism and no deposit insurance equivalent. Recovery, where it has occurred, has depended on voluntary hacker behavior or ad hoc community decisions, not institutional enforcement. No such institutional enforcement mechanism exists. The same architectural feature that makes DeFi resistant to governmental single-point intervention makes it equally resistant to investor protection intervention. Both sides of that reality are real. Both belong in the honest picture. Section 3. Stablecoins and the cross-border transfer dimension. Stablecoins, digital assets designed to maintain a stable value relative to a reference currency, typically the US dollar, have become the most practically significant component of the DeFi ecosystem from the standpoint of governmental concern. The reason? They represent dollar-denominated value that could be transferred across borders without using the infrastructure through which capital flow monitoring and sanctions enforcement currently operate. Let us look at the scale these have reached. According to data from Visa's on-chain analytics dashboard, which applies filters to remove bot activity and automated trading from transaction counts, bot-adjusted stablecoin settlement volume reached approximately $5.7 trillion in 2024. To put that number in context, that is a scale comparable to some of the world's largest payment networks. And the relevant feature for governments thinking about capital controls and sanctions enforcement, a stablecoin transfer bypasses the correspondent banking infrastructure through which capital controls are typically enforced. No SWIFT message, no correspondent bank, no traditional bank account required for the transfer itself. But the accurate analysis requires a critical caveat. The dominant stablecoins, USDT and USDC, are issued by centralized companies that maintain smart contract blacklist functions and cooperate with law enforcement across multiple jurisdictions. This means the stablecoin architecture creates genuine friction against traditional capital control enforcement mechanisms, while simultaneously maintaining a residual centralized pressure point at the issuer level that governments have already engaged directly. The more purely decentralized assets, native blockchain tokens that have no centralized issuer, do not carry this issuer-level control point, making them structurally different from dollar-denominated stablecoins in their relationship to governmental enforcement. Both architectural realities are accurate simultaneously. The transfer mechanism bypasses traditional banking rails, and the stablecoin issuer retains centralized enforcement capability. Understanding both is required for an honest analysis of where governments actually have leverage. And here is what this means for the capital controls lever specifically. When a government imposes capital controls to restrict foreign currency purchases, as has happened multiple documented times in Argentina, the mechanism of enforcement is that banks and authorized exchange dealers are instructed to limit or halt those purchases. If a significant portion of the population can access dollar-denominated value through stablecoin acquisition rather than through the banking system, the enforcement mechanism for those capital controls faces a genuine architectural challenge. This is not theoretical speculation. In Argentina, stablecoin adoption has been among the highest in the world relative to population, driven precisely by chronic currency instability and the restrictions on accessing US dollars through official channels. Section 4. The architectural difference from every prior case in the historical pattern. Executive Order 6102 worked because gold was physical. It existed in specific, locatable places and required physical custody to hold. The prosecution of e-gold worked because e-gold was operated by identifiable individuals running identifiable servers in known locations. The shutdown of Liberty Reserve worked because Liberty Reserve had a registered company structure and identifiable operators who could be arrested and prosecuted. The China 2021 crypto ban was effective within China's domestic regulated infrastructure because China's national internet architecture provides tools for restricting access to specific network services, though, as noted, it was not fully effective in eliminating access through non-regulated channels. A sufficiently decentralized DeFi protocol running on a distributed network of thousands of independent nodes across dozens of jurisdictions has none of these single points of pressure. The protocol has no registered operator, no headquarters, no servers to seize. The code continues to execute on the network, regardless of what action is taken against any specific individual or entity. This does not mean DeFi is unregulatable, and I want to be precise here because that distinction matters. What governments can regulate? The on-ramps and off-ramps. The exchanges and services where users convert conventional currency into cryptocurrency and back. The front-end interfaces, websites and applications through which most users access DeFi protocols. The developers and teams associated with protocols in jurisdictions where they operate. These are all regulatable in the conventional sense. What is architecturally harder to regulate than prior alternatives? The underlying protocol itself, once deployed on a sufficiently decentralized network, continuing to execute regardless of what action is taken against interface operators or developers. The tools that worked on every prior monetary alternative do not map cleanly onto the underlying protocol layer of sufficiently decentralized systems. That is the genuine, specific architectural reason this confrontation is different from the historical pattern. And this brings us to what governments are actively building as their response, and what the published design documents already say about it. Because this is where mainstream coverage almost universally stops. Here is what most people who have formed strong opinions about central bank digital currencies have not done. Read an actual central bank design document. The mainstream media coverage of CBDCs is almost exclusively focused on the political framing, government control, surveillance, freedom, financial modernization, without examining what the actual technical design proposals published by central banks and the Bank for International Settlements specifically say. Very little of that coverage examines the architectural features that central bank researchers have already put in writing and made publicly available. My view on this is direct. If you are going to form an opinion on CBDCs, either supportive or critical, form it based on what the institutions building them have publicly stated about their design, not based on political commentary for people who have not read the source documents. The documents are publicly available. Let us go through what they contain. Section 1. What a CBDC actually is, mechanically. When you have money in a commercial bank account today, what you technically hold is a claim on that commercial bank. The commercial bank, in turn, holds reserves at the central bank. This means there is a layer of intermediation between you and the central bank's liability. If the commercial bank fails, which commercial banks have historically done, your claim on that bank is subject to deposit insurance limits and the bank's actual solvency. A retail CBDC, as proposed across most design documents, would be a direct digital liability of the central bank itself, the digital equivalent of a physical banknote, but held in a digital wallet rather than in your pocket. There is no commercial bank intermediary between the holder and the central bank liability. This is a meaningful architectural change in the structure of money, not a small technical adjustment. And the significance of that change is different depending on the specific design choices made around programmability, privacy, and access, which is precisely where the design documents become important to read. Section 2. The Bank for International Settlements on Programmable Money. The Bank for International Settlements, the institution based in Basel, Switzerland, that serves as the settlement bank for central banks globally, has published extensive research on what they describe as programmable money as a feature of CBDC infrastructure. In their research on what the BIS describes as a unified ledger, a programmable platform that would combine tokenized forms of central bank digital currency with tokenized bank deposits, the BIS describes this infrastructure as opening up a new era in the joint development of the monetary system and the economy. Across their published architecture research, the BIS defines programmability as enabling specific actions to be automatically executed when a set of predetermined and pre-programmed conditions are met. In plain language, money that can be programmed to behave in specific ways based on conditions set in advance by whoever programs the conditions. The BIS research presents this feature primarily in the context of legitimate efficiency use cases. Automated trade finance settlement, a payment that releases automatically when a shipping document is confirmed, eliminating the multi-day settlement delays that currently exist in international trade finance. Programmatic government payment disbursements, welfare transfers or subsidy payments that settle automatically when eligibility conditions are confirmed. Automated margin calls in wholesale financial markets, collateral that moves automatically when a position reaches a defined threshold. These are the use cases stated in the published documents, and they are real use cases with genuine documented efficiency arguments supporting them. Here is what the same documents acknowledge. The programmability feature that enables an efficient, automated trade settlement also enables any other condition that can be expressed in code to be attached to a unit of money. The BIS documents do not advocate for surveillance or spending restrictions. This is technical architecture research, not a policy mandate. But the BIS research explicitly raises the governance question that programmability creates. Who sets the conditions? Under what oversight? With what constraints on what conditions are permissible? Those are political and legal questions. They are not answered by the technical architecture, and they have not been answered in any jurisdiction's published CBDC framework so far. That is what is actually in the BIS documents, not a simple threat, not a simple tool, an architectural capability whose implications depend entirely on government's decisions that have not yet been made. Section 3. The European Central Bank and the Digital Euro. The European Central Bank has been in an extended investigation and design phase for a potential digital euro. The published ECB design documentation addresses, at considerable length, the tension between privacy and anti-money laundering compliance. The ECB's documented position: for small-value offline transactions, privacy protections comparable to physical cash are the design goal, the same anonymity a user has when paying with banknotes in a shop. For larger value and online transactions, the ECB's published position acknowledges that full anonymity is not compatible with AML regulatory requirements that EU member states are legally obligated to enforce. The ECB design documents describe this as a core technical challenge, attempting to build a system that provides genuine privacy for everyday small transactions while maintaining the reporting and monitoring capabilities that AML law requires for larger flows. This is the documented, honest description of what the ECB is attempting to build, not a simple surveillance system, but also not anonymous cash at digital scale. ECB President Christine Lagarde stated publicly at a BIS discussion panel that central banks themselves would not program CBDCs with time limits or spending restrictions, and that such programmability, if it were to exist, would be at the level of commercial bank intermediaries rather than the central bank itself. That is the stated institutional position. It is publicly available. The design question, whether those stated constraints remain in future legislative environments across all member states, is a political question, not a technical one. Section 4. The e-CNY, the most developed real-world example. China's digital yuan, the e-CNY, is the most operationally advanced CBDC deployment at meaningful scale currently in existence. As of recent documented estimates, the e-CNY has been piloted across dozens of cities in China and has processed transactions worth trillions of yuan in pilot programs. The People's Bank of China has published a white paper on the digital yuan that describes its privacy approach as controllable anonymity. The specific meaning of this term, as stated in the PBOC white paper, transactions are private, in the sense that merchants and other users in the transaction cannot see the full transaction history of the parties involved, but the central bank has full visibility into all transactions. This is not a conspiracy claim. This is the stated design principle, published by the People's Bank of China in their own white paper. The e-CNY pilot programs have also included functionality where government-issued digital yuan for subsidies has been distributed with spending parameters, digital currency designated for use within specific categories or within specific time windows. The Bank of Russia's deputy governor, in a 2021 interview at the Cyber Polygon conference, described an analogous programmability use case for their digital ruble. The ability for a parent to send a child digital currency restricted to certain spending categories. The framing in that interview presented this as a consumer convenience feature. The same technical architecture that enables that consumer feature enables a government to apply the same conditions to any holder's money under any future policy decision. This is what is on the public record. And the reason I raise this is not to make a political argument. It is because the mainstream financial media coverage of CBDCs almost never mentions that these design discussions are happening in published documents. They happen at the level of abstract policy debate, without examining what the institutions involved have actually written. Section 5. The legitimate, documented case for CBDCs, stated with full honesty. Financial inclusion is the most verified argument in favor of CBDC development. According to World Bank data, approximately 1.4 billion adults globally remain without access to basic financial services. Many of these individuals are excluded not by choice, but by the structural barriers of the existing system. Minimum account balance requirements, the absence of physical bank branches in their geography, identification requirements they cannot meet, or the cost of maintaining a conventional bank account relative to their income. A CBDC accessible via a basic mobile phone without requiring a bank account, a credit history, or a relationship with a commercial bank has a documented potential to extend basic financial services to populations currently excluded from them. Payment efficiency in cross-border transactions is the second verified argument. Cross-border payments processed through the current correspondent banking system take, by documented measurement, an average of several days to settle, and carry fees that, for remittance payments from high-income to low-income countries, can represent a significant percentage of the amount transferred. A CBDC infrastructure with interoperability standards between central banks could, in principle, reduce both settlement time and transaction costs significantly. Anti-money laundering effectiveness is the third argument. Cash, physical currency, remains a primary mechanism through which financial crime proceeds are laundered in certain contexts globally. A system with greater transaction visibility and auditability could, in principle, reduce the effectiveness of cash-based money laundering. These are genuine policy objectives with documented evidence behind them. The honest answer, and the reason this topic resists easy political framing in either direction, is that the same programmability architecture that creates the financial privacy concern also enables these genuine efficiency and inclusion improvements. The capability is neutral. The danger, or the benefit, is determined by how specific governments in specific political environments choose to use it. And political environments change over time. That is the documented historical reality. Section 6. The structural tension, stated precisely. The tension in CBDC design reduces to this: the same feature that allows a government welfare payment to be programmed to cover only food purchases, which most people would describe as a sensible policy design, is the same feature that could, under a different government, a different policy environment, or a different legislative decision, restrict what any holder can spend their money on, when they can spend it, and where. The technical capability is identical. The constraint is political, and political constraints change. My personal view on this is direct. Financial privacy is a structural component of individual financial sovereignty, not a luxury, not a preference. The capability to surveil all transactions and the act of actually doing so are not the same thing. But once that capability exists permanently in monetary infrastructure, the power dynamic between institutions and individuals has changed, regardless of current policy intent. The honest counter to that view, which deserves to be stated clearly, is that financial surveillance serves documented legitimate functions: disrupting terrorism financing, reducing large-scale financial crime, improving tax compliance. Those are real policy objectives with real documented evidence behind them. Both things are true simultaneously. The tension is not between good and evil. It is between two legitimate but competing priorities. And programmable money infrastructure is the first technology where that tension becomes an architectural design question, rather than just a policy debate. This is what the documents say. Not a simple surveillance system, not a simple efficiency tool, an architectural capability whose implications are genuinely undetermined, depending on governance choices that different countries will make differently. That is what is on the public record, and it is almost never what the mainstream debate is actually about. This is genuinely uncertain, and anyone who tells you they know exactly how the governance of programmable money resolves across all major economies is overstating their knowledge of political futures. There are two documented trajectories for where the confrontation between CBDCs and decentralized finance resolves. Both are real, both have supporting evidence, both deserve the same honest, full presentation. Trajectory 1. Regulatory convergence. CBDCs as the dominant framework. DeFi reduced to a peripheral layer. In this trajectory, the major economies, the US, the European Union, the UK, India, and other significant jurisdictions, successfully coordinate regulatory frameworks that require all DeFi protocol user interfaces to implement identity verification requirements as a condition of legal operation. Stablecoin issuance becomes restricted to licensed entities, banks, and regulated financial institutions, subject to full reserve requirements and transaction reporting obligations. The EU's Markets in Crypto Assets Regulation, MiCA, which came into force across 2024, is the most developed example of this regulatory direction in a major economy. Related legislative frameworks are in active development in the US, UK, and multiple Asian jurisdictions as of the period this video covers. Decentralized exchange protocols face classification as unlicensed money transmission businesses in major jurisdictions, with legal pressure applied to development teams, front-end operators, and liquidity providers who interact with the protocol in jurisdictions where they are identifiable. The network effect of CBDCs, backed by legal tender status, integrated with national tax systems, the default infrastructure for salary payments and government benefit distribution, generates adoption through institutional gravity rather than requiring mandate. DeFi use contracts progressively to technically sophisticated users operating through non-standard access methods, primarily in jurisdictions where enforcement capacity is limited. The implication of this trajectory, stated directly, is that the three governmental levers we covered at the opening are not merely preserved, but architecturally strengthened. A fully digital monetary system with programmable money infrastructure provides more complete monetary policy transmission, more comprehensive financial surveillance capability, and more technically effective capital flow management than the current combination of physical cash and correspondent banking. This is not a catastrophe scenario by default. Every specific outcome of this trajectory depends entirely on the governance framework applied to the programmable infrastructure, governance that varies significantly by country and by the political environment at the time of implementation. But the capability that is built is what it is, regardless of how it is initially governed. This trajectory is technically feasible. It requires regulatory coordination across major economies that has historically been difficult to achieve. But the documented legislative momentum in the EU, the US, and Asia is moving in the direction of greater regulatory clarity and standardization for digital assets, not less. Trajectory 2. DeFi achieves sufficient scale that certain government levers become functionally harder to apply in specific corridors. In this trajectory, stablecoin adoption continues to grow most rapidly through the corridors where the existing banking system is structurally inadequate for the population's needs. High inflation economies, expensive remittance routes, cross-border commerce between parties in different regulatory jurisdictions, where banking infrastructure creates friction rather than efficiency. DeFi protocols achieve sufficient liquidity and verified user participation across multiple jurisdictions that meaningful economic activity, lending, borrowing, structured financial products, occurs on-chain in a way that is not practical to suppress through the regulatory tools applied to centralized intermediaries. Capital controls become progressively harder to enforce completely in effective jurisdictions, not because they are legally struck down, but because the technical infrastructure for moving dollar-denominated value across borders no longer requires a regulated intermediary's participation in the specific transaction corridors where stablecoins have achieved adoption. The documented real-world evidence supporting this trajectory: Argentina's stablecoin adoption as a documented response to currency instability and capital controls. The documented use of stablecoin remittances in Latin American corridors as an alternative to bank wire transfer and money transfer operator services that carry higher fees. The honest implications of this trajectory, and this is not optional to state clearly, it is not a utopian financial system. The documented record of DeFi protocol failures includes verified significant financial losses from smart contract exploits, with particular failures resulting in losses running into hundreds of millions of dollars in individual cases, on the public record. Recovery outcomes have ranged from total permanent loss to mere complete voluntary return of funds by hackers in specific documented cases, but no standardized institutional mechanism guarantees or enforces user protection. No bailout mechanism exists. No consumer protection framework applies. No deposit insurance equivalent exists for funds held in DeFi protocols. No standardized institutional recourse mechanism exists. Outcomes depend entirely on hacker behavior, community decisions, or protocol-level responses, none of which are guaranteed. The same architectural absence of a central authority that creates resistance to governmental intervention creates an equally complete absence of the protective infrastructure that most people have come to rely on in conventional financial systems without thinking about it. Both sides of this reality are part of the honest picture of Trajectory 2. Here is the framing that matters most about these two trajectories. The outcome between them is not determined by which technology is superior. It is not determined by which philosophical framework, financial sovereignty or financial order, is more correct. It is determined by regulatory and legislative decisions being made right now in legislative chambers and central bank boardrooms in Brussels, Washington, Beijing, New Delhi, and London. Decisions that have not yet been finalized, and by whether the technical resilience of sufficiently decentralized protocol architecture proves more durable under regulatory pressure than every prior monetary alternative in the historical pattern. The technology question is largely settled. Decentralized protocols are architecturally different from centralized services in the ways we described. The policy question is entirely unsettled. And the uncertainty between these two trajectories is the honest answer. Not a failure to take a position, but an accurate representation of where the evidence genuinely leaves the question. Based on what the published evidence shows, not ideological preference, not political positioning, but the analytical weight of the documented evidence from institutional design decisions, historical precedent, and current adoption patterns, the most analytically supported trajectory is neither of those two extremes. It is coexistence. Here is the reasoning for that assessment. CBDCs have structural advantages that decentralized protocols do not have and are unlikely to acquire. Legal tender status, the government mandate that they must be accepted as payment for debts, provides an institutional foundation that no decentralized protocol can replicate through technical means alone. Direct integration with national tax systems, government payment infrastructure, and commercial banking settlement creates a network effect through institutional adoption rather than voluntary user preference. The backing of sovereign monetary institutions provides a foundational level of systemic stability that individual DeFi protocols, which have demonstrated vulnerability to exploits, liquidity crises, and cascading failures in specific documented cases, do not provide. For national day-to-day commerce, retail payments, payroll, government transfers, tax remittances, CBDCs have a clear institutional path to becoming the dominant digital form of money in economies that adopt them. DeFi has structural advantages that CBDCs do not have and cannot replicate by design. The ability to facilitate value transfers across borders without requiring any central counterparty's participation in the transaction itself. The ability to execute programmable financial contracts between counterparties in different jurisdictions with settlement finality without either party relying on the legal system of the other's country. The architectural resistance to single-point failure. No central server whose failure takes down the system. No operator whose prosecution stops the protocol from functioning. For cross-border value transfer, for programmable contracts between parties who do not share a legal jurisdiction or trust the other's legal system, and for use cases where the specific absence of a central custodian is the required feature, the architectural advantages of decentralized infrastructure are real and verifiable. The critical observation: these two sets of use cases do not fully overlap. They are not complete substitutes for each other. A CBDC is not a replacement for a smart contract protocol that executes across jurisdictions without a central counterparty. A DeFi protocol is not a replacement for the legal tender infrastructure that enables everyday commerce, tax collection, and government payment distribution. The precedent worth considering carefully. Gold and government-issued fiat currency coexisted throughout the entire 20th century. Gold did not replace fiat currency. Fiat currency did not eliminate gold's role as a stored monetary value and a central bank reserve asset. Both existed simultaneously in a world that had a clear dominant form of money for everyday transactions and a persistent parallel layer serving different, non-overlapping functions. The documented evidence from current adoption patterns suggests a similar dynamic is the most supported trajectory for CBDCs and DeFi, not because of any philosophical preference, but because the use cases differ at an architectural level in ways that make full mutual substitution unlikely. Now, let me return to where this video started. May 2013, a single legal document sent to a web hosting company in Costa Rica. Over 1 million users, more than $6 billion in processed transactions. Gone within hours. That was a centralized system. One document reached the one point of pressure that mattered. The network ceased to exist. The reason governments are investing serious institutional resources in understanding decentralized finance and simultaneously accelerating central bank digital currency development is not because DeFi is predicted to replace money. It is because for the first time in documented monetary history, the architectural answer to apply force to the single point of pressure is not straightforward. The single point of pressure is not there by design. The three levers, monetary policy transmission, financial surveillance, capital controls, are the mechanisms through which governments have managed monetary systems for decades. They have shaped every major monetary crisis response, every major sanctions regime, and every currency stability intervention in the modern period. Decentralized finance is the first monetary technology that creates simultaneous pressure on all three, without a single identifiable structural point where that pressure can be resolved through a court order, a prosecution, or an administrative action. Whether the response to that fact results in CBDCs strengthening those levers through a more complete digital architecture, or in a parallel financial layer emerging outside those levers in corridors where they are hardest to enforce, or in the coexistence the evidence most supports, is a genuinely open question. And it is being decided right now in regulatory and legislative processes happening in real time across the major economies. Understanding the mechanics clearly, not through ideology, not through speculation, but through what the design documents actually say and what the historical pattern actually shows, is what this video was built to give you. One final precision. This video has not argued that DeFi is a safe investment, that it will succeed, or that it should replace anything. It has not argued that governments acting to preserve their monetary levers are acting in bad faith. What it has argued, based on verifiable sources, is that this tension is real, that it has a specific technical basis, and that understanding that basis clearly is the prerequisite for forming an honest opinion about it. That is the honest answer to why governments fear decentralized finance. If the structural analysis in this video is the kind of thinking you want to apply to your own approach to financial markets, and if you want a framework for understanding risk, crisis, and the pattern of how financial systems respond to stress, I have a book that is directly relevant to what we covered today. It is called The Black Swan Investor: Timeless Lessons on Risk, Crisis, and Opportunity from History's Greatest Financial Crises. Not a history book, a practical framework for building a resilient financial mindset capable of identifying both risk and opportunity in environments that most people find disorienting. The structural pattern we covered in this video, how established institutions respond to disruptive monetary alternatives, is exactly the kind of dynamic the Black Swan Investor examines through the lens of historical market crises. The link is in the description. The QR code is on screen. Both direct you to Amazon.com, the US store. If you are watching from India, the UK, or anywhere else, simply change the .com in the URL to your country's domain. .in for India, .co.uk for the UK, for faster and often cheaper shipping from your local Amazon store. Two other books in the description are also directly relevant: The Asymmetric Bet, a contrarian investor's framework for finding genuine opportunity in situations where others see only risk, and The Capital Decay Equation, a mathematical framework for long-term capital preservation. All three links are in the description below. Since you stayed through the full analysis, the end screen videos appearing right now go deeper into the structural dynamics of global finance. If this gave you something worth thinking about, the subscribe button means you will be there for the next one. I will see you in the next video.